and the Environment's Clean Energy Finance Forum, and I'll be your host today. We're excited to present the third and final webinar in a series focused on accessing creative revenue sources for clean energy in the United States. Today's presentation is being brought to you by the team at the Yale Center for Business and the Environment's Blueprint for Efficiency, which is in its 6th year of providing public webinars, emphasizing the latest trends and opportunities for energy efficiency. We're also thrilled to be co-hosting this series with the Council for Development Finance Agencies, the CDFA. It's been a really interesting and informative series so far, and we're really looking forward to another great webinar today. So the topic today is advancing energy finance. Which policies have the biggest impact, rather. We'll be looking at a range of policies currently in place and being considered around the US to support investment in renewables and energy efficiency, and discuss the context in which different policy options might be the most effective or easy to implement. So I'd like to start by welcoming our excellent panel of speakers. First up, we have Dr. Devashree Saha, Senior Policy Analyst and Associate Fellow at the Brookings Institute's Metropolitan Policy Program. Following her will be Casey Bell, Senior Economist and Finance Policy Lead at the American Council for an Energy Efficient Economy, the ACEEE. Finally, we have Jason Rittenberg, Director of Research and Advisory Services for the CDFA. Each presentation is recorded and available through the Yale Center for Business and the Environment website and the Blueprint for Efficiency iTunes U page. A link to download the slides from today's presentation has also been posted in the chat window. I'd like to remind our listeners that we'll leave plenty of time at the end for a moderated discussion with all of our speakers, so please type any questions that you might have into the GoToMeeting chat window. And with that, I'd like to hand it over to Devashree.
Thanks, Michael, and good afternoon, everyone. I'm Devashree Saha, an Associate Fellow at Brookings Metropolitan Policy Program, and it's a pleasure to welcome so many of you to this discussion on how to advance clean energy finance and which policies have the biggest impact. Can we have the next slide, please? So this is really an exciting time for the clean energy sector, one that is characterized by a changing landscape and new opportunities. Renewable energy, for instance, has become a technology of choice for many Americans, accounting for nearly 40% of all new domestic power capacity installed in 2013. And the array of technologies is increasingly becoming cost competitive with conventional energy sources, and costs continue to fall. According to Bloomberg New Energy Finance, private sector investment in the US clean energy sector surpassed $100 billion in 2012-2013, stimulating economic development and supporting thousands of jobs. Despite this substantial progress, clean energy still suffers from serious funding and financing gaps. A recent report by the Center for American Progress noted that the transition to a clean energy future in the United States alone requires $200 billion of investment per year for the next 20 years. So where is this money going to come from? Next slide, please. Brookings Research has previously documented that federal policy and subsidy support for clean energy has declined by about 75% in dollar terms since the height of the 2008 Recovery Act. Meanwhile, it's hardly news to any of you in attendance today that fiscal stress and political gridlock have not only greatly reduced the availability of top-down subsidies and grants from Washington in recent years, but promise to depress their availability for the foreseeable future. And at the same time, state and local governments are also facing budget problems that will likely preclude efforts on their part to offset the federal pullback with new grant and subsidy programs. So the implication of all this is that either with or without federal support, different types of innovative financing mechanisms are required to scale up the clean energy industry as it weathers a period of inconsistent policy support. Next slide, please. At Brookings, we have been trying to understand how states and regions can make progress on their own, regardless of the situation in Washington. In this vein, we have sought in the last 3 years to identify and promote some of the most promising state and local experiments at financing clean energy scale-up without direct support or grants from Washington. Working with Lou Milford and Clean Energy Group, we noted how a number of state clean energy funds have been experimenting with a broader industry development focus as opposed to simply funding individual projects. Similarly, we have worked with CDFA and Lou Milford at Clean Energy Group on scaling up bond financing for clean energy projects. And Jason will talk more on that. Finally, we have worked with Reed Hunt and Ken Berlin at the Coalition for Green Capital on state green banks, which I'm going to discuss in more length today. Next slide. So one of the more interesting experiments that is going on in the country is state green banks. Green banks are nothing but state-chartered financing authorities that use limited public resources to leverage greater private investment in clean energy. And their goal is to grow the clean energy market as quickly as possible while saving money for consumers and preserving taxpayer dollars. So how do they work exactly? Let's say a homeowner wants to make energy efficiency upgrades or install solar panels, but might not be able to pay for the expensive equipment. A private investor or a bank could loan money to the owner and earn a return, but often that's not what's happening. The private investor may be hesitant to make loans if they're unfamiliar with the equipment being financed or if they are unsure that the owner would repay. So enter green banks, which can help lower the risk for private lenders and investors. And one way they do this is through credit enhancement, such as insurance against default. A green bank can agree to cover some of a private lender's losses if borrowers don't repay their loans, improving or enhancing the credit quality of the original loan. And with lower risk, loan originators are often willing to make more loans, possibly at lower interest rates, and thus a history of loan performance builds. So essentially what green banks are doing is that they're making sure that the supply and demand for reasonably priced capital meet and the market for clean energy grows. And to be financially self-sustaining, green banks offer finance mechanisms that provide a payback for investors. And these can include a variety of tools such as direct lending and co-lending, on-bill financing, credit enhancements, including loan loss reserves and loan guarantees, and PACE. State green banks, finally, are also playing a critical role in bringing clean energy investments to scale. Small disaggregated projects are notoriously hard to finance, especially for energy efficiency. It is just too expensive for institutional investors to underwrite such small loans. So green banks warehouse smaller loans and securitize or sell the loans once the warehouse is adequately large. Next slide, please. It goes without saying that establishing a state green bank is no small feat and requires going through a number of steps. But generally, you may think of three stages to establishing a state green bank. In the first stage, a coalition of stakeholders, which can include clean energy organizations, clean tech trade associations, environmental groups, and state agencies. These stakeholders establish a base of support for a green bank, and this support is really critical to passing legislation or achieving the required regulatory change to legally create a green bank. In the second stage, the green bank organization or entity is established, and this can include different things like hiring staff, building capabilities, identifying goals, assessing markets, and developing products. And in the final stage, the green bank actually begins acquiring customers, lending in partnership with private investors, and recycling funds in order to recapitalize the bank. And one important question that needs to be addressed is regarding the structure of the green bank. And although a green bank may take a variety of forms, there are generally three structures to consider. First, as was done in Connecticut, the green bank can be standalone as a quasi-independent entity, and this kind of model allows for the most flexibility and autonomy. Another option is for green banks to be housed within an existing state agency. The New York Green Bank operates according to that model. Lastly, a green bank may be incorporated into an infrastructure bank where it would likely be established as a separate subsidiary. And regarding the sources of funding, so it can receive its initial funding from several public sources. In both Connecticut and New York, existing state funds, system benefit charges, were repurposed, and regional greenhouse gas initiative funds were also provided initial capital for the green bank. Alternately, as was done in Hawaii, the state can issue bonds to private investors. Then state green banks can also receive money from cap and trade auction revenues and private foundations. This will obviously all depend on the state and legal structure established when the green bank is created. Next slide. The state green bank movement is really gaining momentum. Connecticut created the first green bank in 2011, and in the 3 years since then, the green bank there has facilitated $350 million in clean energy investments. That's the same amount that the prior grant-making entity did in 11 years. Then New York has created its own $1 billion green bank, and that was in 2013, and it has already announced $800 million of clean energy investments, 600 of which is from private investors alone. Then Hawaii, California, and New Jersey have created similar clean energy finance initiatives, and the common thing across all these state green banks is that they intend to leverage private dollars to increase investment in clean, reliable energy. Then there are other states like Minnesota, Vermont, Maryland, Rhode Island, and possibly others, which are also exploring their own green bank initiatives. I guess to sum up, I would say that without green banks, the private sector may eventually find ways to provide low-cost financing for deploying clean technologies, but this might be sometimes far into the future, and I'm not sure we can afford to wait for that. So I'll stop here, and happy to take questions later.
Excellent. Well, thanks, Devashree. I'm Casey Bell. I'm a senior economist with the American Council for an Energy Efficient Economy, and I lead our finance policy work. And I'm happy to talk to you today about the current landscape for energy efficiency finance policy. And when we're talking about energy efficiency, we aren't necessarily talking about generation. We're talking about measures and technologies that save energy at the point of delivery. Next slide. So for those of you unfamiliar with the American Council for an Energy Efficient Economy, ACEEE, we are about to have our 35-year anniversary. This slide's a little out of date. And we are a nonprofit that supports its advocacy work for energy efficiency through our externally reviewed research. We are possibly best known for our state energy efficiency scorecard, which ranks the states by their energy efficiency policy. And I would encourage you, if you take a look at where your state is, if you'd like to see that number go up, to reach out to me after the presentation, and we can connect you with our state policy staff. The finance policy program focuses on best practice policies and market mechanisms for driving energy efficiency investment. Next slide. We also host an annual Energy Efficiency Finance Forum. Every year as I plan this event, which sees about 300 attendees, I like to think in themes. And the theme this year around energy efficiency finance and energy efficiency investment really is a critical moment. Slide. While we're seeing an unprecedented amount of capital be deployed into the marketplace, we're also seeing shifts in policy that are both helping us to deliver that more effectively, as well as to drive demand for energy efficiency. And I'm going to talk a little bit about policies at the federal, state, and local level that support demand for energy efficiency finance. So you see on this slide that we have, oh, that's all right. We are working with a market that has a $279 billion investment potential. That's a number that was estimated in 2011 by the Rockefeller Foundation and Deutsche Bank, and that the industry is moving along 3 parallel tracks. On the one hand, we're trying to put together the infrastructure to drive capital to the market, both by attracting investors as well as trying to figure out how to build energy efficiency loan products into asset-backed securities to sell to secondary markets. We're developing mechanisms for effective delivery that can potentially be structured to serve harder to reach markets. And at the same time, we're also investing in solutions that drive demand both on the policy side and in terms of intelligent efficiency or information technologies that can give you more information about building energy use, which may serve down the road to drive additional demand for energy efficiency investment. Next slide, please. Very briefly, this is a slide that sort of captures that first theme on driving capital into the market, and it shows a number of the players in this space that are providing capital for different types of projects and financing efficiency through different mechanisms across different sides and different sectors of the market. Next slide, please. These next 2 slides just highlight some promising mechanisms, on-bill financing, which has been adopted in the following states, as well as, next slide, PACE programs or property assessed clean energy, which allows customers to repay their efficiency obligations through property tax assessment, and these are the states that have adopted policies and implemented programs. Next slide. And Devashree talked about the green bank movement, so I won't spend too much time on this, but these are some of the states that are either considering or have adopted or have started to implement a green bank. Next slide. And you can just skip to the next slide. Moving back to the theme of a critical moment, driving demand, and the theme of this webinar, I'm just going to talk a little bit now about how policy is evolving to support financing at the federal, state, and local level. You see now that 24 states have mandatory energy savings goals or energy efficiency resource standards. These are a huge demand driver for energy efficiency investment, though we do see these threatened in some states. 40+ states have national model building codes. 8% of national electric generating capacity is from combined heat and power. It's estimated that $1.1 trillion will be saved from existing appliance standards and equipment efficiencies through 2035. Next slide. For once, I'm thrilled to announce some good news out of Washington. So just last week, the President signed into law the Energy Efficiency Improvement Act of 2015. This is a collection of 3 useful but relatively modest provisions on residential water heaters and commercial buildings. But it really is, we see it as a positive step forward. And in a remarkable show of coordination and convergence, both houses of Congress have scheduled hearings next week on energy efficiency. The House has not released any details on its hearing yet. But we know that the Senate Energy Committee hearing will cover 22 bills that have been introduced this year. And our executive director has been invited to testify at that hearing. If you'd like some more information at some of the policies that are going to be discussed, please follow up with me afterwards. But a lot of the policies that are listed on this slide are on the table. Next slide, please. Perhaps our best hope for driving demand for energy efficiency investments is Rule 111D. So 111D, the EPA is requiring states to develop implementation plans for emissions reductions using its authority under the Clean Air Act. Next slide, please. A report by ACEEE demonstrates that for many states, savings goals can be met mostly or entirely through energy efficiency. We are in the process of preparing technical assistance on how financing might be included as part of a compliance strategy. Now, the final rule was expected in June, but may slip to July or possibly even later, I'm hearing. We are also expecting court cases to challenge the rule. That said, we don't expect these challenges to slow the 12-month clock between the final rule and the due date for implementation plans. So it is really probably a best practice for states not to delay their planning because if they don't begin to put together their compliance plans, they risk getting stuck with a federally mandated plan. Next slide, please. And these are 4 policies that we highlight within the report that can help states within their implementation plan to reduce emissions. And we see, the annual energy savings goals, investment in combined heat and power being real opportunities for financiers that want to get involved within the energy efficiency space. Building energy codes may certainly go a long way to drive demand for projects as well. Next slide. In addition, there's lots of policies to drive demand at the state and local level. So we just highlight a few of these here. The energy efficiency resource standards, again, have a very, very high potential to drive demand. And then we also see policies such as loan loss reserves as being credit enhancements that may help mitigate risks from an investor perspective in engaging in lending for energy efficiency. We see benchmarking and disclosure policies and policies that help us better understand building energy use as potential demand drivers. Next slide, please. And you can just skip to the next one, too. A key to unlocking demand from our perspective isn't just providing loans, it's making sure that energy efficiency is properly valued by owners. Some data initiatives that are designed to, again, give us better information around building energy use to potentially drive demand. Next slide. So I'm just going to leave you with some final food for thought. When it comes to delivering financing effectively, we in the energy efficiency community are now facing 2 of these open-ended questions as we talk about how best to deploy financing solutions. We see that many offerings are capitalized or subsidized by ratepayer dollars. So the first question that we have here is what is the best way to deploy public dollars to maximize energy savings? And then the second question, which we see is very important at ACEEE, is since we're using public dollars for deploying financing solutions, how do we ensure equitable access to the multiple benefits of energy efficiency? And with that teaser, final slide here, if you're interested in the policies and the issues that I've highlighted here, I strongly encourage you to attend our annual Energy Efficiency Finance Forum, which will be June 1st through 2nd in San Francisco, where we will be exploring these issues in much greater depth. And I should also mention that if you have a project that is currently in need of capital, this is the final week to apply for our CDFA deal room. We are working with CDFA, who's about to present next, to match projects that are relevant within the space to capital. We have a lot of financiers that attend the conference. We have a very, very brief application that's attached to this slide, and I would encourage you, if you have any questions or think that you might have a project that is eligible, to reach out to me after the webinar. So thank you very much, and I will turn it over to Jason.
Great, thank you, Casey, and definitely thank you for mentioning the deal room. We're really excited to be working with you guys on that. I'm looking forward to going out there, and the projects we've been talking with so far seem really interesting. So looking forward to getting to actually be in the room with them and find some investors. So thank you. All right, so again, thank you all for being on the call today. I think this is a really interesting topic, and I enjoyed getting to hear my fellow panelists talking about their perspective on policy. Energy policy is definitely an area that I have found to be particularly engaging. One of the things that has always struck me as really interesting about it, from my perspective at CDFA, is how isolated it can be from the rest of economic development. So for those of you who don't know, let me just do CDFA in 30 seconds. We're a national trade association. We have more than 400 member organizations throughout the country. Most of them are public sector, the groups that do economic development finance. That finance piece is particularly our niche. So the groups that do bonds, tax increment, loan programs, tax credit, investment programs. And again, we're all throughout the country, so we work with both state and local level. And then on the private side, we also work with banks, law firms, and project consultants, and really focus on how you finance economic development and how you finance anything that might be counted as economic development. So we have programming best practices and research and technical assistance that supports infrastructure finance, small business finance, brownfield finance, and then energy as well. And one thing that we noticed when people started to come to us more, and our members started to talk to us more about clean energy and how to finance renewables, how to finance energy efficiency, we started to understand just how separate so many communities throughout the country keep their energy offices, and particularly the renewable energy offices, from their economic development offices. And on the surface, there are some reasons why that makes sense, but what's interesting is that a lot of times infrastructure gets financed in the same way, regardless of what type of infrastructure it is. And to us, energy, definitely is a piece of infrastructure. It's part of, electricity, and so it seems pretty clearly to be infrastructure. We didn't really see that as being much of a question mark. But then because it ended up being treated separately by the state agencies, what we saw is that there are many places that really only focused on energy-specific programs. So if I'm going to finance energy, whether that means renewables or if that means efficiency, then I need a, branded, quotation marks, however you want to look at it, capital letters, energy program. And what we tried to do once we started to identify that was help communities think through their existing economic development finance tools and how those can be put to use either directly or with some modifications, and then be able to finance energy improvements and do some of the work that I think we all want to do to try to have more efficient energy use, to try to have better sources of energy generation. And so our focus in the energy space at CDFA has really been on integrating economic development and energy programs and policies. In addition to that energy infrastructure piece, the other reason that we look at it is finance is finance. If you have a project that has a good source of repayment, or you have a borrower who is creditworthy, then at the end of the day, we can convince the market to want to take that project's debt on, regardless of what the financing itself actually is. And sometimes it does take some convincing, particularly, we saw with solar, more so up to the last couple of years, that banks and underwriters were concerned about the technological risk that went along with the normal borrower risk. But I think those challenges are starting to be put to rest. At least we're in a better position than we were a few years ago. And so once again, you get to that point where a deal is a deal. And so let's look at how we can start to finance some of the energy programs with tools that we have right now. So our focus on that policy, and the focus that I want to take today, because again, we do cover a wide range of policies at CDFA, but what I wanted to focus on today is federal policy that leaves decision-making about projects and sometimes even about spending priorities at the local level. Because that sort of federal to state or local relationship, I think, is really critical, in part because the federal government obviously has a lot more financial assets than many state and local governments do, but then also because it's a way to try to address the equality, or at least the equity, of having these programs in place. If you just leave everything in the energy space up to the states, what we saw from that great map, from all the great maps that Casey had, what ends up happening, there are certain states that care a lot more about this or are able to put together the political will to make a difference, and then other states don't. Whereas if you have a policy that's at the federal level but still leaves that decision-making local, we found that when it's time to put the money where the mouth is, a lot of states, regardless of how red they are still willing to work with some of these programs and make improvements in their states. So it's so that's where we want to focus today, on that federal policy at the local level. So one of the main tools that we work with at CDFA and that I want to talk about now is tax-exempt bonds and how they can play in the energy space. So a tax-exempt bond, anytime you're dealing with a bond, you're really just talking about a debt instrument. So it's a loan, it's just a massive loan that's being sold to investors instead of to the bank, at least in most cases, keeping things high level here. So what is a nice benefit about tax-exempt bonds, these can include municipal bonds that are issued by a city or state and backed by the city or state. And they can also cover private activity bonds. But what's nice about those bonds, regardless of the form, is that the interest is exempt from federal income tax, and typically state and local as well. And so as a result, the investor isn't paying taxes on the money they're making from holding the bond, and so they don't need the interest rate to be as high in that bond as they would if it was taxable. Because at the end of the day, if they're going to pay a couple percentage points worth of interest and they're willing to just accept the lower interest rate in the first place and not have to pay tax on it, it works out to be the same or better for the investor. And what that means for projects, what that means on the energy side, is that if you can use tax-exempt bonds to pay for your energy project, then you can have a cheaper project or a bigger project, depending on how you look at it. So that's tax-exempt bonds in a nutshell. When it comes to private activity bonds, these are tax-exempt bonds that are used for private development. And there are three main kinds that can be particularly useful for energy development. The first that I have on this list here is industrial development bonds. These are bonds that go to small to mid-sized manufacturers. They're capped at $10 million, so that's the biggest bond you can have for these projects. And they need to be to a relatively smaller, again, or mid-sized manufacturer because there are limitations on how much that company can have spent on facilities or land acquisition in a certain window. But without getting into nuts and bolts, small to mid-sized manufacturers, $10 million in bonds, and they can be tax exempt then. And what you can do with this in the energy space is you can put solar panels or you can put wind. In some cases, you can make efficient upgrades, especially if they're just moving into a new building. And as long as these upgrades are happening with the part of the manufacturer that actually does the manufacturing, so not just the warehousing, not just the R&D department or something, but actually on the manufacturing piece, then you can use these bonds and you can do improvements on manufacturers. And manufacturing, of course, is a huge, huge sector when it comes to the users of energy. So doing what we can to improve the energy use here can be really key. 501c3 bonds are also eligible for energy. They can do both efficiency and they can finance renewables again. So if there's a 501c3 operator, the World Wildlife Fund had a really big bond that they did. It helped finance their LED. I think they were platinum on their DC office. I can't remember for certain, but they had 501c3 bonds there. Zoos have used these before, so 501c3 operators can get access to tax-exempt bonds. And then exempt facilities bonds, and these ones I actually want to go into a little bit more. Exempt facilities bonds finance public-private infrastructure. So if you think about many of your major energy users, once you get past manufacturing, a lot of times you're looking at infrastructure, things like water treatment plants, waste plants. So those are types of infrastructure that you can finance with exempt facilities bonds, and you can then use these bonds to get low-cost capital to make improvements. We've seen several communities throughout the country take a look at putting solar panels on their wastewater treatment plants or doing other types of processing that can really reduce their energy costs. And this is the type of bond that even if you have a private operator can be applicable. Exempt facilities bonds can also finance combined heat and power and biomass. As long as it's a private operator, they can do that regardless of the facility type. So if you have a manufacturer, maybe too big to be able to use an industrial development bond, but they want to do biomass, you can use an exempt facilities bond and then finance it that way. So a lot of good options. Now, you see on this list here that exempt facilities bonds can finance combined heat, power, and biomass anywhere. But what they can't finance is other renewables, and they can't really be used for efficiency improvement. So one policy point that CDFA has been working with a few different members of Congress and the Senate on over the last few years, and is working on again now, is to try to have renewables added into the exempt facilities definition. You could also finance solar and wind. Definitely makes sense with the other categories that are currently financed with the exempt facilities language. Then you could finance a lot more renewable installations throughout the country for a lot of different types of operators, and they'd be able to do it more affordably and therefore be more likely to do it. So in some ways related to bonds, but apart from bonds, I also wanted to talk for a moment here about credit enhancement. So one issue that does come up with any type of project when you're trying to look at financing it and going through a debt tool is trying to figure out where that repayment source is going to come from. And a lot of times, particularly with the banking regulations where they are, a bank doesn't just want to see that you have a repayment source, but they also want to know that they have great collateral, great coverage, really strong loan to value. So there are thresholds that they have to get to before a bank is going to be willing to finance any type of project. Sometimes that can be tough for an energy project if you're trying to talk a business into making an improvement or making some sort of renewable installation on their property. Well, they might be able to pay for it with the lower energy costs, and so they're willing to go through with the project there. But if they don't also want to commit additional assets that they have as collateral, then they could end up in a situation where they're a little bit short on the credit side. So there are a number of instances where this comes into play. Manufacturers have this challenge, small businesses have a similar type of challenge, and so energy isn't going alone. And what we've seen on the manufacturing and energy and small business side is that there are a great deal of programs that are able to provide credit enhancement from public monies that the bank can accept. The bank can make the regulators happy because they're using credit enhancement. It doesn't have to be tied to the borrower as long as the bank's protected. And so they're able to then lend to these projects. So the Federal State Small Business Credit Initiative is a really innovative program style where Treasury was allocated money by Congress. Treasury approved small business credit programs to the states, but the states are running their own programs. There are over 150 programs that are being operated from State Small Business Credit Initiative funding. And so that's allowed a great deal of flexibility, not to paint just a rosy picture. It's definitely had its challenges as well as some states pick programs that weren't designed optimally. But we've been able to develop quite a few best practices And on the whole, states are able to design programs with federal funding that fit their specific local needs. And so it's been a really, really powerful program for small business lending. So CDFA has two policy ideas in this area. One is a federal state clean energy finance initiative for just for lack of a better name, I suppose, but taking that same SSBCI model but applying it to clean energy. The federal government could provide funds that then the states could use to provide credit enhancement and provide capital access for energy projects based on the challenges in their specific states. Then you'd be able to see a lot more of this type of investment throughout the country, again, regardless of what the political appetite for each particular state might be. Also, and very much to Devashrie's point that she had early on, states should also be looking to invest in energy credit enhancement. It doesn't fit the broad perspective that we prefer to see at CDFA, but states, instead of just looking at financing, how do we grant money, how do we loan to a project and take all of that project risk onto ourselves, states should also be looking at how they can make investments into programs that just support, that do a better job of enhancing a loan so that they're leveraging a lot more private dollars. So that's the perspective I want to present today, and a handful of policy proposals that we're really focused on here at CDFA, and I am very much looking forward to having more of a policy conversation with questions that you can all submit to us, and then questions that Michael at Yale has for the panel. Thank you.
Great, thanks Jason, and thanks to the other speakers as well. So I'm going to throw a few questions to you guys. We'll start sort of broad, and then we can get a little bit more specific as more audience questions come in. First question was, what do all of you see as the role of the state government versus, of the federal government versus state governments versus local governments in shaping clean energy finance from a policy point of view?
This is Jason. I'd be happy to jump in first on this one. So, as I said, the perspective that we're taking, at least for today, is really looking at trying to have capital come from the federal government. Again, mostly focused on that as kind of an equity point. But really, the states and the locals need to be the drivers on this, both because, one, there's a lot that they can do. If you're a state or local government and you want to do these types of programs, there are a lot of different ways that you can capitalize loan programs, that you can be creative about looking for funding sources. Devashri mentioned the systems benefits charges before. We actually know of a city that is looking at doing a kind of pooled purchasing and then taking part of the savings that the ratepayers will experience and using that to kind of create their own systems benefits charge, where they're going to put half of the savings into an account. So you can get really creative at the state and local level if you want to, but we do like to see the federal government play a role in at least supporting programs as they can so that there's equal access across the country.
Yeah, and I'll just add that even at Brookings, even though we feel that the federal government, there has been a huge pullback, we do emphasize that both state government and the federal government needs to work in partnership. And just to give the perspective from the green bank side, state green banks can work with or without federal programs to support clean energy, but I think they are most they're most effective when they build upon what is offered by the federal government. For instance, many of the potential private investors in clean energy projects are encouraged by tax credits or subsidies which are provided at the federal level. And if these incentives are eliminated, it greatly reduces the private investor appetite for clean energy investment that state green banks aim to leverage. So definitely, the federal government has a huge role to play as well. It has a long history of financing large critical infrastructure that offers broader public benefits to citizens, and that's a role that we would like to continue to see.
And I would just follow up by saying, while the state and local governments probably have the greatest potential for developing the solutions and deploying them, that the federal government can play a really important role in setting standards, both legislatively and administratively through setting standards for emissions and building codes, but also through some of its administrative authority in helping us to answer some of these valuation questions that sort of present a bit of a market failure within within the market for energy efficiency finance.
Great. Okay, so on the topic of state-level action, I've seen a lot of movement, especially toward the green bank model in in the Northeast and in some of the more sort of blue states, and not much progress in the red states. So my question is, do you see the green bank model catching on in red states? How do you see that happening? And particularly, how do you sell that model to legislators or to the general public who isn't necessarily as concerned about climate change as as other parts of the country?
I think that we see a lot of potential in sort of the movement towards resiliency investment. So, while the first movers on the green bank front have been New York and Connecticut, as well as California and Hawaii, we also see that New Jersey, which one wouldn't necessarily classify as a red state, but one certainly that is led by a Republican governor right now, making a move toward investing in resiliency, which can often include clean energy and energy efficiency. In fact, that's a critical component of resiliency investment. New Jersey is in an interesting position because it's responding in some ways to Hurricane Sandy, but I think we see a lot of red states in areas that could benefit from a more stable grid. So I think that's one opportunity. The other comment that I would make is that as we establish these green banks, we should also be looking to sort of the existing programs within the state that have been delivering energy efficiency finance, some for many years now through other programs, and how to sort of leverage effective lessons learned from those programs as we sort of build them into these sort of centralized models.
Yeah, and I would just jump in and add here that in dealing with many states, especially through hosting the Green Bank Academy, we heard this comment, that I don't believe in climate change, or I support the continued use of fossil fuel in my energy market. So why should I support a green bank? So I guess the quick answer there would be that one does not have to be worried about carbon emissions to recognize the value of energy efficiency. By reducing wasted energy through retrofits and better construction and consuming energy more wisely through, let's say, smart grid technologies, total energy consumption can be reduced. Green banks help consumers save money on energy, strengthen our national security, and generate other economic benefits independent of any discussion on climate change. And generally, we have seen that green banks can be and have been supported by members of both parties, simply because they help to create cheaper, cleaner, and more reliable energy. Things which both red and blue states should like.
So I really like this question, and honestly, it's exactly why CDFA is not really a proponent of green banks. We definitely like the concept of them, but politically it does get to be a hard sell. So I wouldn't necessarily look for any of your very conservative states or states, regardless of their political affiliation, that have big coal interests in them to be putting a green bank in place, because politically that's not going to happen. So instead, what you want to focus on with those states is on an infrastructure bank, or on how they can basically put an infrastructure bank, or how they can be more aggressive about using their existing tools to finance energy. And so, you think of a state like, New Mexico. That's a state that really is kind of on the cusp, I guess, in terms of where exactly they fall politically. And they're not very aggressive on the energy side, at least that I've seen. But they do have an infrastructure bank that they put in place. Even more so, North Dakota, definitely a state that's not, real big on democratic policies, but they've got an infrastructure bank in place that's great. So if that bank is willing to go and look at energy projects as well, then they can still be able to finance them really effectively. We've heard a lot about Kentucky not wanting to take on green because they have too much coal interest and they're not going to do green, but they're putting PACE in place. So a lot of it is just going to be about how you actually talk to the politicians. So instead of maybe focusing on the green, instead of focusing on renewables, focus on infrastructure, and that infrastructure includes energy. And that if you do energy efficiency, or if you allow manufacturers or businesses to choose for themselves to take a renewable path and just provide them a cheaper way to finance it, then you're going to save those manufacturers money and get more jobs. So again, when we talk about this issue, we like to focus on affordable capital, on infrastructure, and on jobs. And I think that's the way you go with those states. And then they might not create a quote green bank, but you can get the powers and tools that a green bank would have.
Right, and a final note, just to piggyback on that, from a policy perspective, while we see a lot of promise in sort of the green bank model, we do see a need for them to demonstrate some proof of concept before, in terms of being sort of a high value in terms of energy savings, before we pour all of our public resources that have been dedicated to setting up mechanisms for delivering energy efficiency to customers. We'd like to see some proof of concept before advocating that all those dollars be poured into the green, before advocating for a widespread adoption of the green bank model.
All right. So the next question comes from the audience, from Dan, who's asking about regional or state level carbon taxes or cap and trade schemes. He's wondering what role these could play in supporting or funding some of these policies, assuming that federal action, a federal carbon tax or a federal cap and trade scheme is probably pretty unlikely at this stage.
Well, I can talk a little bit about the, the Clean Power Plan and, sort of the federal mandate that states meet certain levels of emissions reductions. Again, while widespread cap and trade policy is not very likely, this is sort of one of the ways in which the federal government is setting standards. We are in the process. We think that establishing financing programs could be an effective compliance mechanism if, in fact, we can design them in such a way to encourage uptake. But the challenge for helping them to meet that standard is finding the most appropriate way to measure and evaluate the effectiveness of these programs. But we are in the process of developing technical assistance around how that could be accomplished.
So the other thing that I'll add on to that is that I believe that California's new policy that they're putting in place is going to actually provide a source of capital that they're going to be able to put back into programs that have environmental benefits. I'm not sure how much of that is going to go to energy programs or exactly what type. I think people are also looking at it for environmental cleanup and some other issues as well. But if you have a policy that is going to be raising money from people who are, or from businesses that are in compliance, then that's a potential source of fund capitalization.
Great. Okay, the next question also comes from a different Daniel, and he's asking about any experiences or any knowledge out there amongst the panelists for financing models really looking at low-income residents around community solar projects or community energy efficiency projects, and how policy instruments might be used to help grow that portion of the market.
I can jump in and say that green banks can support low-cost, income-specific clean energy programs in a number of ways, including by offering low-cost, low funds or loan guarantees to CDFIs, other community organizations, and nonprofits. They can also establish loan loss reserves that can reduce the credit requirements necessary for consumers to access clean energy programs. I know that the Connecticut Green Bank is working to reduce the barriers faced by homeowners to obtain rooftop solar through the Solarize Connecticut program. The program has reduced its minimum credit score requirements for solar leases to 640, though this credit barrier is still too high for many low-income families.
Yeah, that's definitely good. The Connecticut model is a good one to look at. I actually would really encourage Daniel to check out, I believe it was the last webinar we did. Michael, correct me if I'm wrong, but we had, with Chris from Denver Housing Authority talking about what they do to finance solar and energy efficiency on low-income housing. And one of the big tools that they use is HUD has a kind of guarantee of a power purchase agreement program that low-income residential projects can put into place. So I definitely would encourage you to look back at that. Some other things that we've seen, it's possible potentially to use special assessment type of programs or tax increment finance to do solar projects. You would have to have a pretty solid district and have a developer really committed to it, but that'd be something else that you could, another way that you could finance it in addition to other programs that Connecticut put in place you might want to look at too.
Yeah, and I would just add, recently, last year, Center for American Progress released a paper on state policies to increase low-income communities' access to solar power. So that may be, and that has some good examples. So that may be something that you may want to look at as well. But that just focuses on solar.
Great, thanks for that. And yeah, Jason, that's right. We did address a bit of that in the last webinar, and those slides are available for download at the CDFA website. So if you if you browse around there, you'll see the webinar 2 from this series covers a lot of those issues. Okay, so next we've actually had a couple more questions about green banks. I'm going to try to combine them into one long, convoluted question. But to what extent, and this comes from Steve and Vanessa, to what extent do green banks seek to provide good value to customers as opposed to investors, in contrast to many solar leasing options out there that aren't really providing great value to customers these days? And also, what sort of default rates are green banks experiencing right now, and how does that really compare to private cost of capital that, the risks that are facing private investors?
Well, I'll start with the second question first, the default rate. I know it is pretty low, though I don't have the exact statistics now, but I think it's, last I heard, it was less than 1%. But don't quote me on that. And I think green banks definitely offer a great value to consumers, also investors. I mean, they are increasing the value of taxpayer dollars through leveraging private capital. They're catalyzing market transformation and generating a host of other public goods. And I mean, they have just reduced the upfront cost for accessing clean energy programs in the states that that they have taken root, especially Connecticut, and we've seen that somewhat in New York as well.
Yeah, I also do not have numbers specific to green banks. Looking more broadly across the types of programs that green banks put into place, the municipal markets the last 5 years are well below a percentage point in terms of default, around 0.03. I think you might come up closer to a percentage if you're looking only at private activity bonds, but default rate there is, again, very, very low. And those tools are backing up the capital source for a lot of these subloans. And so if those tools are doing really well in terms of defaults, and you're going to see a pretty low rate as well on the loans that are coming out of the green banks most of the time. In terms of a general economic development loan fund, it's pretty common. It seems like most of the members who we know what their default rates are under 5% usually, and those are funds that are specifically designed to be a little bit more risk-taking because they're stepping in where banks won't. So 5%, of course, is still pretty good, and many of them are more around 2% or even lower. Kind of also depends on exactly how you're defining default. They define default typically a little bit more broadly than more literally, I guess, than a bank would as well. But still, pretty low rates there. So I think you're looking at good success. You don't have a lot of history. Sometimes, I mean, I was talking to a bank investor who's interested in investing in loan funds, and they want 8 years of track record, and you don't have a lot of funds out there that have those types of numbers available yet. Mike, did we get that whole question? Michael, did we get the whole question? I forget what the first part was.
I think so. The first part was really about, to what extent do green banks seek to provide good value to customers as opposed to investors? And I think, in bringing down the cost of capital and, that kind of, it all ties together, I guess.
Yeah, absolutely. I think that's where they do provide the benefit, is that they can do it at a lower cost. The number that seems like every energy program that I look at is really focused on is, how many years until this is paying for itself. What's your payback going to be? And that number keeps coming down, and having a financing tool that lowers your interest rate is just going to, get you to that payback point even sooner. So I would say that's the value the customers get.
Great. So unfortunately, that takes us to the end of the webinar. We're out of time. But I'd like to thank Devashri, Casey, and Jason for making this really fantastic webinar. I'd like to thank everyone for listening in and contributing to far too many questions we had time to put to everyone. And I'd like to remind everyone that today's talk will be made available online through the Yale Center for Business and Environment website, as are the other presentations in this series. So with that, I'd like to say please keep an eye out for the next series of webinars when we return in the fall. And so long from New Haven, Connecticut. Thank you.
Thank you.
Thank you.